The last concept we're going to cover in Chapter 11 is the concept of transfer pricing. So when we have different divisions within the company, one division may provide a product to another division, and we need to determine what the best price would be for that transfer. So a transfer price is the price that's charged when one segment of a company provides goods or services to another segment. The fundamental objective in setting transfer prices is to motivate managers to act in the best interest of the overall company, not their own division. There are three approaches: negotiated transfer prices, which is what we're going to spend our time talking about, and then just setting transfer prices at cost or at market price. Negotiated is the best approach that's going to maximize the benefits for the company overall. So how do we figure out negotiated transfer prices? Well, if you think about being a buyer and a seller, each party wants something different. As a buyer, I have a maximum amount I'm willing to pay. I want to pay the least amount possible, but I have a cap. I'm not going to pay more than X. As a seller, I want the most money possible, but I have a minimum I'd be willing to accept. And as long as the seller's minimum is lower than the buyer's maximum, we can make a deal. So when we talk about transfer pricing, we're really going to play a game of deal or no deal. And we're going to have to figure out if, given the circumstances, would we be able to make a deal to transfer from one division to another and benefit the company overall or not. So to demonstrate this, we're going to go through an example with a grocery storehouse. They have two divisions, West Coast Plantations and Grocery Mart. West Coast Plantations has navel orange harvest capacity per month of 10,000 crates. The variable cost is $10 a crate. Fixed costs are $100,000, and the selling price to the outside market is $25. Right now, Grocery Mart is buying their oranges from somebody and getting a great deal at $20 a crate, and they need 1,000 crates a month. So the question becomes, can we do an internal transfer? And the selling division is going to have to figure out what their lowest acceptable transfer price is. Well, hopefully it makes sense that the seller certainly isn't going to want to sell it for any less than their variable cost per unit, right? Because if it costs them $10 to harvest the oranges, they certainly can't sell the oranges for less than $10 or they'd be losing money. The next component represents the opportunity cost, and this part's a little tricky, and I don't think the book really does the best of jobs kind of breaking down how to calculate it, so I'm going to hopefully help you with that. The opportunity cost is the cost of the next best alternative. So this is going to play a role when we don't have enough capacity to meet the needs of the transferring division. So if the other division wants 1,000 crates and we only have 500, how are we going to get them 1,000? Well, we're going to have to take 500 away from our current customers. So in order to figure out this numerator part, what you're going to do is figure out the units taken away from current customers to make the deal internally times the CM for current customers. So if I have to take away units from current customers, I lose out on that contribution margin I could have made from that sale. So however many units I take away from current customers to do the internal transfer times the CM for the current customers is our total opportunity cost. Then we divide that total amount by the number of units transferred because we're trying to get a price per unit. It'll be easier to understand that when we apply it with some numbers. The buying division, super easy. The buyer's not going to pay any more than they're already paying to the outside world. So if they're paying $20 to an outside supplier, they don't want to pay any more than $20, because why the hell would they? If they can get it for $20, they're not going to pay more than $20. So let's look at an example. If West Coast Plantations has sufficient idle capacity, they have 3,000 crates of idle capacity, and Grocery Mart only wants 1,000, so they got plenty to go around. So the way I figure out the units taken away is I figure out my capacity minus my sales to outsiders. And though they don't give us all the details, they said capacity was 10,000. So I'm assuming the sales must have been 7, which gives us our excess, which is the 3,000 they told us. Then we take the units transferred away from that, which is 1,000, and that gets us our units taken away. Now, I just use thought to think this through, not a formula. I give a formula because when I'm face-to-face with students, they always want one. So I'm just assuming you will too. So this is only if negative. This is why I don't like a formula. In my head, this is what I do. I go, hey, self, you don't know how to spell excess, self. All right. So I say, self, if I got 3,000 crates and they want 1,000, do I have enough? Yup. And I move on with my friggin' life. But students like to be a little more systematic. They want a little formula, a little magical formula. So here's your magical formula. But you have to understand that when I get a positive number here, that's not the units taken away. Only if it's negative do I have to take away units. The 2,000 we get there is the extra I have beyond the 1,000 the other one needs. So when I'm doing my little formula, which if I go back, remember is units taken from current customers times CM. Because this 2,000 isn't negative, the units taken are 0 times the CM to the outside world, I believe was 15. Doesn't matter because 0 times anything 0, but that's selling price minus variable cost, and I'm pretty sure that West Coast Plantations is selling at 25. Their variable cost was 10. So 0 times anything is 0, so we don't really need to go through this, but I just want you to understand where the number truly is coming from. So that's why 0 is in the numerator, and then you divide that by the total units transferred, which is 1,000. But of course, 0 divided by something is 0, so you end up at the variable cost of $10. So that's the minimum. The maximum is what the other division is already paying, and they're paying 20. And because the max is greater than the min, we can make a deal. So whenever the max is greater than the min, we can make a deal. Any deal between 10 and 20 bucks will work. When the max is less than the min, no deal. We shouldn't make a deal. Okay? And the way it works is if you should make a deal, and you do, the company's better off by the difference between the max and the min, because we're keeping the money inside the family, right? We're not giving it out to those third parties. We're keeping it inside the company. If we force a deal when we shouldn't be making a deal, the company overall is going to be worse off because nobody's winning. The selling division doesn't win, the buying division doesn't win, and the company overall loses as a result. It's always the difference between the minimum and the maximum, though, to figure out how much the company is better or worse off. Doesn't matter what the actual transfer price is. So basically what I mean by that is the difference is $10. So if we do this transfer of 1,000 units, the company overall is going to be better off by 10 grand. If we don't do it, the company will be worse off by 10 grand. It doesn't matter what the price is. You want to set the transfer price at $1 billion? You can do that because all you're doing is taking money from one of your pockets and putting it into another, one division to another. So the max and the min are determined based on the company or division's interaction with third parties. So that, or those are the only two numbers that really matter in determining how the company overall will be better or worse off. So remember that. First, you figure out what the max and min is. If the max is greater than the min, you can make a deal. If the max is less than the min, you shouldn't make a deal. The difference between the max and the min is how much better or worse off the company will be by doing it if they should or not doing it if they should not. Now let's look at another example where we have no idle capacity. So using that little formula, now our excess is 0 minus the units transferred of 1,000 gives us units taken away And because it's negative, it is actually units taken away. So we're going to take the units taken away times our CM to the outside, which I already figured out earlier was 15 bucks. And then that's going to give us our transfer price. And you'll notice that it ends up being the 25 bucks that we're already selling it to third parties for. And that should make sense. If we're selling all the oranges we have for 25 bucks, why the hell would we sell them for any less? The formula gets us to that point, and I recommend you use the formula because you never know what might change in the problem. It could tell you that to do the internal transfer, it's not going to cost us 10 bucks. It'll cost us 9 bucks because we don't have to pay commissions for an internal transfer. And then the answer will be slightly different. So you want to use this format no matter what to get to the right answer. Don't think you've got some shortcut and you'll always get the right answer with the shortcut. Write it out, do it out, and you won't have a problem. So here the seller's minimum is 25 and the buyer's max is 20. So our max, how did I write it on the previous slide? Max and min. Oh. Okay, so our max of 20 is now less than my min. So it's no deal. And the difference of the max and the min is $5. So if we force a deal, the company's going to be worse off by $5,000. The $5 per unit times the 1,000 units. It's always the difference between the max and the min. It doesn't matter what that transfer price is. Why are they going to be worse off? Because we shouldn't make a deal. So if we force a deal, they'll be worse off by $5,000. If we don't force a deal, if we keep buying from third parties, they're better off by $5,000. And this is like Goldilocks. So we had too hot, too cold. Now we got something in the middle. So now we have some excess capacity. Our excess is 500 crates. The units transferred are 1,000. So now our units taken away is negative 500. And because it's negative, we have to use it as taken away. And that gets us a transfer price of $17.50. So now, because my max is again greater than my min, 20 is greater than $17.50, we should make a deal. And if we do, the company overall is going to be better off by $250 per unit times 1,000 would be 2,500 bucks. So if we make the deal, the company overall is going to be better off by 2,500 bucks. You're always better or worse off by the difference between the max and the min. To know if you're better or worse off, you got to first determine if you need to make a deal or not. Here we want to make a deal. So if you do what you should, you're better off. If you don't do what you should, you're worse off. So again, if a transfer within the company would result in higher overall profits, there's always a range of transfer prices within which both the selling and buying divisions would have higher profits if they agree. So whenever you have a max greater than the min, you can transfer it somewhere in the middle. Both divisions get a little more profit, and the company overall is going to win. They're going to have a higher profit. If managers are pitted against each other rather than against their past performance or reasonable benchmarks, that non-cooperative atmosphere is almost guaranteed. And then they might fight amongst each other and make decisions that aren't in the best interest of the overall company. So because of that, most companies rely on some other means of setting transfer prices. They either set transfer prices at cost, but the problem with this is it might result in sub-optimization, which is a fancy way of saying the company isn't going to be better off in the end. You might force transfers at cost. That hurt the company and actually cost the company overall more money. The selling division's never going to be able to show a profit on an internal transfer, so there's absolutely no benefit to the seller. That may harbor resentment, a little hate. And then the cost-based transfer prices do not provide any incentive to control costs, because if I'm going to get reimbursed for all of my costs, might as well go out on a vacation and charge that to the company, because who gives a shit? I'm going to get the cost reimbursed. So not the best approach, but doesn't take any effort to calculate because you already know what your cost is, so some companies choose to do it. The opposite extreme would be to charge market price. The market price approach works best when the product or service is sold to outside customers and the selling division has no idle capacity, because if that's the case, then you have to sell it at market to make it make sense, because otherwise the selling division loses money in that lost opportunity cost that we talked about. A market price approach does not work well when the selling division has idle capacity, because they could technically be selling it for less than market and still getting a profit. So the best approach, when all is said and done, is negotiated transfer prices, and that's what all of our problems will have you calculate. Oh, how did we get to this point already? Can you believe it? That's the end of chapter 11. As with all of our chapters, you need to practice. There's a lot of practice problems on Canvas and Connect. I recommend you use them both. Use the resources available. Reach out on the discussion boards for help. Reach out via email if you want to set up Zoom office hours. We're here for you. We want you to succeed. Please, please practice, because that's the way you're going to do well in this class.